Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence.
Eurozone's problems don't seem to be over. The private sector activity declined for a second month, with Germany and France being the weights on the bloc. S&P Global's composite PMI inched up in October but stayed just below 50, signaling contraction. The UK's composite PMI fell more than expected to 51.7 but remains in the expansionary region. Meanwhile, US stocks remained calm ahead of the November 5th election, contrasting with rising volatility in Asian markets due to concerns over Chinese stimulus and Japan's upcoming vote. The volatility gap between the S&P 500 and the MSCI Asia Pacific Index is at its widest since 2017 as per Bloomberg. Good morning, JK. What's your take on the PMI release yesterday? Are you seeing some sort of a recovery for the Eurozone?
Yeah, good morning, Swaraj. Not really, because as you said, it is still in the contractionary territory. While Germany did show some marginal improvement, but it cannot be taken for granted that they are recovering because most other indicators from Germany have been very weak. Today, we'll also have the IFO survey from Germany on the business sentiment, so that will be very closely followed. But yesterday's data showed France actually slumping much more because France is the second largest economy in the Eurozone. So there's a lot to work as far as Eurozone recovery is concerned. And it is not surprising that there has been a unanimous voice from many Eurozone policymakers that ECB should go for hefty rate cut and perhaps even on rate. Perhaps they are perceiving, it is probably not apparent in the data, perceiving that growth is much softer or there is a bigger slump. So actually, if you go beyond the data, the Eurozone's problems are more structural, and they have been outdone by the innovation in the US and China, and that's one of the big reasons. And in this regard, actually, we have come to know that that Mr. Draghi, the former ECB president, and he was also the prime minister of Italy. He has submitted a comprehensive report for Eurozone to quickly act on changing the growth trajectory. But I think the political system in Eurozone is the main reason why they are not able to take a quick decision on how to go about it. So I think Eurozone takes much longer to recover. So the data will continue to be weak, and perhaps they are finding the easiest way would be for cutting rates. That's why there is pressure on ECB to cut rates by 0.5% and much more in the coming months. On the UK, data was slightly weaker than expected, but all focus is on October 30th budget statement from the finance minister Reeves, and there is already an indication there will be some tax hikes because the fiscal position of UK is bad unless they find new ways of raising resources. Government's aim of focusing on growth may not gain traction. So 30th October, important for UK. As far as US is concerned, PMIs are not so relevant because we are into the election time. All the data looks to be of secondary importance, although the GDP and PC inflation, maybe also the unemployment report on 1st November, all coming in quick succession, will be the focus for Fed, at least, as they meet immediately after the US election on November 6th. So US is all focus is on US and Eurozone and UK, obviously not not the prime focus right now in the market. Japan also, because of the election on 27th, which may see the ruling party coming down in their strength, but they may still form a government with a coalition. But that may actually weaken their policies. And some of the opposition parties are calling for quick rate hikes in Japan, and also even to lower the inflation target from 2% to 0%. So that's a drastic view, but I think that's unlikely to happen. Meanwhile, we are hearing voices of dissent from Japanese officials about the recent weakness in the Japanese and beyond 152. Not sure whether they will directly intervene, and not sure whether even if they intervene, how much effect it will have, because markets seem to be a bit more confident after having broken 150 mark decisively. That's about the currencies. On the rupee, continued outflows, 5,000 crores more yesterday from 30th September till now, more than 12 billion. Now, look at it. This is the next highest outflow we have seen from FIS after March 2020 COVID period, when we had seen over 15 million of outflows. The way to look at it is that if US, obviously Indian economy currently is in a much better shape. In fact, growth is high, and relative to other economies doing much better. But why should we see such outflows? I can only put down two reasons. One is the valuation, and the other is the Chinese economy attracting fresh investment. So there is some diversification that is happening that has resulted in these outflows. But that said, the index in India has fallen about 7%. That does not really reflect the hefty falls that we have seen in many of the non-index related stocks, averaging between 25 to 45% fall in the value of those shares. So valuations have definitely got adjusted in many of the sectors. Why I'm focusing on these stocks is because most of the outflows have happened from equity market. And so if markets do perceive value buying in India, I think these outflows may actually end. And maybe I think November 5 or a little after that, once we know how the policies of the US new government will come about, then we may see a reversal in the flows that can see the rupee also, gain a bit of attraction, provided dollar index is also not very strong. Only caveat is that if the yields in US and the globally also, if they keep going up further, then it may put some pressure on the bond market in India. So the equity outflows may stop, but the bond market outflows may be seen, which can see again rupee remaining at the lows. So all eyes from me will be on how the flows pan in the coming days, and perhaps November 5 will be the key day, or a little after that. After that, we will see how the rupee behaves based on the flows. Thank you.
Thank you, JK. And just quickly summarizing, Germany showed some improvement, marginal improvement, but most other indicators have been weak. Yesterday's data also showed France slumping more. So two major countries of the EU facing economic troubles. So the pressure is on the ECB to create more conducive monetary environment by way of rate cuts. On the UK, while the PMI was weaker but remains in the expansionary zone, the focus is on the October 30th budget speech. Fiscal side is tight, so they may be raising taxes. The recent weakness in the Japanese yen has sparked verbal warnings from the Japanese officials. And for rupee, we are seeing continued outflows, $12 billion worth of outflows from September end. Yesterday was another 5,000 crores of outflows. So the pressure remains on the rupee. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with the latest in the financial markets.